At its peak, Cracker Barrel was a $3 billion restaurant empire with more than 660 locations spread across 45 states. A company so woven into American road trip culture that its rocking chairs became more recognizable than half its competitors' logos. But in just a few short years, that same beloved brand found itself fighting for relevance, facing declining traffic, rising costs, and a wave of investors openly questioning whether the chain built by truck stop travelers in 1969 can survive the world of 2026. How does a company that fed generations of American families, that built one of the most profitable dual restaurant retail models in dining history, suddenly find itself under this much pressure? Stick around, because by the end of this video, I'm going to show you the one object sitting quietly in almost every Cracker Barrel parking lot that perfectly symbolizes everything that went right and everything that's now going wrong. In this video, I'm going to break down exactly how Cracker Barrel rose from a single roadside store in Tennessee to a nationwide multi-billion-dollar institution. I'll show you the business model that made its growth almost inevitable, the false peak that convinced everyone it was untouchable, and the slow, compounding failures that have brought it to where it stands today. And if you stick around until the end, I'll tell you about a single, symbolic object, something so simple, so ordinary, that most customers walk right past it without a second thought, that tells you everything you need to know about where this brand is headed next. Let's get into it. The story starts in 1969, in Lebanon, Tennessee, with a man named Dan Evans. At the time, America's highway system was exploding. Interstates were cutting across the country faster than ever, and millions of families were hitting the road for work, for vacations, for a new kind of American mobility. But there was a problem, a gap in the market that nobody had solved well. If you were driving cross-country, your options at a highway exit were bleak: a gas station, maybe a diner, maybe nothing at all. There was no place that felt like home in the middle of nowhere. Dan Evans looked at that gap and did something nobody else in the industry was doing. Instead of building just another diner, he combined two completely different business models into one. He built a restaurant serving hearty, Southern, home-style cooking, and he attached a full retail country store to it, stocked with candy, toys, decor, and nostalgic Americana. This was the opposite of what fast-growing chains were doing at the time. While others were stripping down their format for speed and efficiency, Cracker Barrel went the other direction, leaning into nostalgia, into slowness, into the feeling of stepping back in time. Early locations were placed deliberately near major highways, specifically to catch interstate travelers who wanted more than just a quick bite. They wanted a stop, an experience, a taste of the country on their way through it. The timing was perfect. America in the late 1960s and 1970s was hungry for authenticity, for a sense of tradition in an era of rapid modernization. Cracker Barrel gave people exactly that: rustic decor, Americana collectibles, and eventually, its most iconic symbol, rocking chairs lined up along the front porch, inviting travelers to slow down before they even walked through the door. Competitors couldn't easily copy this. Building a genuine restaurant retail hybrid required a completely different operational model, different real estate strategy, and a brand identity most companies weren't willing to commit to. Cracker Barrel had found something rare: a business built on emotional legitimacy, not just convenience. It deserved its early success. And that success didn't stay small for long. So what actually powered Cracker Barrel's expansion from a single Tennessee store into a nationwide chain? The answer lies in its dual-revenue business model. Every location wasn't just a restaurant, it was also a retail store. That meant every single customer who walked in to eat breakfast was also a potential retail customer before they even sat down. Guests would browse candy, toys, seasonal gifts, and branded merchandise, including the now famous branded rocking chairs, often before or after their meal. This dramatically increased the average spend per guest compared to a typical sit-down restaurant chain. This model allowed Cracker Barrel to grow faster and more profitably than competitors relying on food sales alone. The retail side wasn't a side hustle. It became a meaningful share of total revenue, effectively giving Cracker Barrel two profit centers under one roof. Add to that a menu built entirely around universal comfort: biscuits, gravy, pancakes, eggs, bacon, chicken and dumplings, meatloaf, country fried steak, and hash brown casserole. This wasn't cuisine that needed to be explained or marketed hard. It was food people already craved, served in a format they already trusted, with large, family-oriented portions that reinforced a powerful sense of value. The company expanded steadily, not recklessly, throughout the 1970s and 1980s, carefully choosing highway-adjacent real estate rather than rapidly franchising the way many chains did. In 1981, Cracker Barrel became a publicly traded company, listing on NASDAQ under the ticker CBRL, giving it access to capital markets to fuel continued, disciplined growth. This allowed Cracker Barrel to grow faster than almost anyone expected, not through gimmicks, but through a genuinely differentiated model that competitors found difficult to replicate at scale. By the time Cracker Barrel had grown into a nationwide chain with locations across 45 states, it looked, from the outside, completely unstoppable. This was a company generating annual revenue in the multi-billion-dollar range, with a market capitalization that hovered around $3 billion. It had built a reputation so strong for breakfast, biscuits, and country cooking that its name had become shorthand for a specific kind of American road trip experience. Families planned entire trip stops around it. Travelers recognized the exit signs from miles away. The brand had achieved something incredibly rare in casual dining: genuine cultural validation. It wasn't just a restaurant chain, it was a piece of Americana. Cracker Barrel had maintained a consistent brand image for decades, and that consistency had built deep customer recognition and loyalty across generations. Financially, the company had every marker of stability and strength. It generated strong, consistent cash flow. It paid regular dividends to shareholders year after year. At times, it even returned additional capital through share repurchases, the kind of financial discipline that signals a mature, dependable business, not a company on the edge of trouble. Investors loved it. Families loved it. Road trippers loved it. At this moment in its story, there was no reason, none, to believe Cracker Barrel was anything other than a permanent fixture of American highway culture. But underneath that comfortable, nostalgic surface, something had already started to shift. Here's the thing about Cracker Barrel's success: the very foundation that made it great also planted a quiet, long-term vulnerability. Cracker Barrel's entire identity was built around nostalgia and Americana: antiques, vintage signs, old-fashioned decor, a country store atmosphere frozen in a very specific era of American life. That formula worked brilliantly for the customers who grew up with it: travelers, families, and, increasingly as decades passed, older diners. This worked for a long time. But it planted the seeds of something dangerous: a brand identity almost entirely dependent on an aging customer base. As younger consumers came of age, their dining habits looked completely different. They gravitated toward faster, more modern, more convenience-driven options. A full-service, sit-down concept built around leisurely nostalgia wasn't the natural fit for a generation raised on delivery apps, drive-thrus, and fast casual efficiency. At the time, this wasn't fatal. Cracker Barrel's core demographic was large, loyal, and still driving the highways in significant numbers. But the flaw was there, quietly compounding in the background. A brand whose greatest strength, its unwavering consistency, was also becoming its biggest long-term risk. From here, the pressure didn't arrive all at once. It built, one problem stacking on top of the last. First, the market shifted. The casual dining industry as a whole became highly competitive. Traffic at traditional sit-down restaurants began facing sustained industry-wide pressure, not just at Cracker Barrel, but across the entire category. Then, competition intensified. Cracker Barrel wasn't just fighting other Southern comfort food restaurants like Texas Roadhouse. It was fighting Denny's and IHOP for the breakfast crowd, Waffle House for Southern breakfast loyalty, and an entirely new category of fast casual chains built around speed and convenience. Delivery apps changed consumer habits almost overnight, and takeout and drive-through formats, areas where Cracker Barrel's full-service, sit-down model is structurally slower, became increasingly important to how people wanted to eat. Then, reputation and demographic pressure compounded. The company's older customer base, once its greatest strength, increasingly became a demographic risk. The brand faced growing pressure to modernize, But modernization is a double-edged sword for a chain whose entire value proposition is built on tradition. Change too much, and you risk alienating the loyal base that built you. Change too little, and you risk irrelevance with everyone else. Then the economics stopped working as smoothly. Inflation pushed food costs higher across the board. Labor costs rose sharply across the entire restaurant sector. Supply chain disruptions, affecting nearly every operator in the industry, added yet another layer of cost pressure. Same-store sales growth became inconsistent in some periods, and profit margins came under sustained pressure from rising expenses on almost every side of the business. And finally, leadership faced difficult strategic choices. Should the company chase innovation and risk its identity, or protect tradition and risk stagnation? Management began discussing how to attract younger guests, refreshing parts of the menu, adjusting retail assortments, and pushing harder on operational efficiency, but these were reactive moves to problems that had already been building for years. No single event caused this. It was market shifts, competition, demographic risk, and rising costs, all compounding quietly at the same time. Then came the shock that exposed every one of these vulnerabilities at once: the COVID-19 pandemic. The pandemic disrupted dine-in traffic almost overnight, and dine-in was the core of Cracker Barrel's model. Travel-related traffic, the very lifeblood of a chain built around highway locations and road trips, declined sharply as families stopped traveling and stopped stopping. Cracker Barrel adapted as best it could. It expanded curbside pickup. Off-premise sales became more important than they had ever been in the company's history. But retail sales, the second half of its signature dual revenue model, were also hit hard by declining store traffic, since fewer diners meant fewer browsers walking the aisles of the country store. The recovery that followed depended heavily on whether highway and family travel would return to its previous rhythm, and even as it did, new problems emerged. Labor shortages hit the restaurant industry hard in the aftermath of the pandemic. Commodity inflation surged, pressuring profitability just as the company was trying to rebuild traffic. Cracker Barrel had to walk a tightrope, raising prices to offset costs while trying not to alienate the value-conscious, loyal customer base it depended on. This was the moment where a chain that had weathered decades of gradual, manageable change suddenly had every underlying weakness exposed at once, and forced into the open far faster than anyone expected. What followed wasn't a dramatic bankruptcy or a headline-grabbing scandal. It was something quieter, and in some ways more difficult to solve: a slow erosion of momentum. Traffic pressures that had been building for years didn't reverse, they persisted. Margins remained squeezed by the combination of inflation and labor costs that had never fully retreated to pre-pandemic levels. Same-store sales growth remained inconsistent, a red flag that restaurant industry investors watch closely, since it often signals deeper structural issues rather than short-term noise. The company's mature, highway-anchored footprint, once its greatest strategic advantage, now limited its ability to expand rapidly into new formats or new markets the way more flexible competitors could. Analysts increasingly compared Cracker Barrel's performance against other casual dining chains, and the comparisons highlighted a brand caught in the middle, not fast enough for the convenience-driven younger consumer, and increasingly strained in serving its traditional base profitably. Dividend sustainability, long a point of pride for the company and a key reason income-focused investors held the stock, became a more closely watched topic. Investors began asking, openly, whether a brand built on 1970s highway nostalgia could find a sustainable path forward in a dining landscape reshaped by delivery, convenience, and shifting generational tastes. This is a company that never stopped operating, never stopped serving biscuits and gravy to millions of guests, but that quietly moved from being seen as an unstoppable American institution to being seen as a brand fighting to prove its long-term relevance. Remember that symbolic object I promised you at the start? It's the rocking chair. For decades, the rocking chairs lined up along Cracker Barrel's front porch were the perfect symbol of everything the brand did right: an invitation to slow down, to relax, to step into a nostalgic version of American life before you even walked through the door. The company was so proud of this symbol that it sells branded versions of these very chairs inside its own stores. But today, that same rocking chair carries a very different symbolic weight. A rocking chair doesn't move fast. It doesn't adapt quickly. It's built for stillness, for tradition, for a pace of life that an entire generation of new consumers isn't necessarily looking for anymore. The same porch that once made Cracker Barrel feel timeless now raises an uncomfortable question. In a dining world defined by speed, delivery, and constant reinvention, can a brand built around sitting still keep up? That empty rocking chair, swaying gently on a quiet porch, is Cracker Barrel's entire story in a single image. The thing that made it beloved is the exact thing it now has to figure out how to evolve beyond. The biggest lesson here is this. The very strength that builds a brand can quietly become the constraint that limits its future. Cracker Barrel's nostalgia, consistency, and unwavering commitment to tradition are exactly what built a multi-billion-dollar company out of a single roadside store in Tennessee. But those same qualities made it slower to adapt when consumer behavior shifted beneath its feet. This isn't a story about a company that made one catastrophic mistake. It's a story about a brand whose greatest asset and greatest liability were, all along, the very same thing. The tension between tradition and reinvention doesn't resolve itself. It has to be actively managed, and how well a company manages that tension often determines whether its brand strength becomes a lasting advantage or a slow-moving trap. So here's what I want to know from you. Can a brand built entirely on nostalgia, on rocking chairs, biscuits, and highway traditions, actually modernize without losing what made it special in the first place? Or is Cracker Barrel's rise and current struggles simply the natural life cycle of every beloved American brand, inevitable no matter what choices management makes? Let me know what you think in the comments. And if you enjoyed this breakdown, make sure to subscribe, because there are a lot more rise and fall stories like this one coming.